All right, why don't we get started? So thank you very much for joining. My name is Mark LaMonica. I'm going to talk today about income and growth investing. And we're going to take two different angles on it. We're going to talk about environments where one may be better than the other. We're going to talk specifically about sort of where we are right now. And then we're going to talk about personal circumstances, which are also important. But first, anything you hear today is general advice. I don't know anything about you, so I can't offer personal advice. If you're over in New Zealand, you get a copy of our FAP on our website, morningstar.com.au, and you should reach out to a financial advisor if you want personal advice. All right, so let's get started. So a couple things. Obviously, we'd love it if you listen to the podcast, followed us on Instagram. And once again, our conference, so we put out tickets for our conference yesterday. So they are officially out there. There's an early bird rate. It's a really exciting lineup. I think it's a really exciting lineup. So Shani planned it. She did a great job. And what we're really doing is we're focusing on you as investors. Many conferences are very focused on investments. You have a bunch of people come in that are pitching different investments, but we're going to go through the entire goals, asset allocation, investing in the current environment, security selection process. And it comes with a guide, which I believe is like 90 pages that shows you how you can do it yourself. Sign up for a conference. If you want a good deal, send me an email at mark.lamonica1@morningstar.com. All right. So we're going to go back in a time machine to a year ago. That man right there is Jerome Powell. He happens to be the chairman of the Federal Reserve in the US. So every year, a bunch of the Federal Reserve economists and the different managers of the different branches all go to Wyoming. They go to Jackson Hole, Wyoming, to talk all things monetary policy. And it is capped by a speech by Jerome Powell. So last year, on August 27th, he gave a speech, and this is a quote from the speech. And basically what he's saying is inflation's up a little bit, it's going to go away. Right, so he's sitting there saying in the speech that, inflation is at 4.2%. It's up over our objective, which is we want to keep things around 2%. So it's up a little higher, but it is going to go away. So he's saying there are a number of factors that suggest these elevated readings are likely to prove temporary. So what, of course, has happened since then? Well, everything that he said here was wrong. And a lot of other central bankers, including in Australia at the RBA, were all saying similar things. Inflation will go away. Everything's fine. No need to raise interest rates. And of course, they were all wrong too. So the question now is that if Jerome Powell and Philip Lowe were so wrong a year ago, and we went through a period of time, or we went through a period where the expectations of everybody and what we were being told by central banks were that interest rates were not going to go up for potentially years down the line. And now, of course, they have. They're in the process of continuing to be raised. And inflation has gone from, 4.2 and 3.6%, depending upon what we're looking at, headline versus core inflation, up to over 9% in the US, over 10% in the UK, and steadily climbing in Australia. Australia seems to be a little bit behind the US and the UK, but seems to be going in the same direction. So if they were so wrong, what would be the impact on the market? Well, overall, it hasn't been much. Now, there's been a lot of volatility, but if we go back and we look at the S&P 500, since that period of time, including some pretty big losses overnight, it's down around 8%. And then if we go and we look at the ASX 200, down around 6%. So pretty interesting that we went from a period with market expectations of temporary inflation, no interest rates going up, to a period where we have seen very high inflation that we haven't seen since late 70s, early 80s. and interest rate rises and slowing economies, and yet the market isn't down that much. Now, why is that? Well, for some reason, well, not for some reason, is because the market, of course, is looking forward, and the market has come to terms with what's been happening and has basically rallied over the past couple months with this kind of very rosy scenario in place, right? And this rosy scenario kind of goes as follows, that inflation has peaked. The interest rate increases we're seeing will slow and then eventually stop, obviously bringing inflation under control, because that's why they do that. We'll have some mild economic pain, and then we're going to get back into rate cuts next year. So this is kind of the scenario that the market's looking at. Now, obviously, we don't know what's going to happen, but this is what people have kind of collectively decided. And this is why we've seen a pretty big rally, right? So we've seen, markets, particularly in the US, which had fallen more, go up around 15% in the past couple months. We've seen a similar rally in Australia as well. But what we need to always ask ourselves as investors is what is priced into the market realistic? Because once again, it's always those expectations of the future. If the market expectations change, and all of a sudden they don't think interest rates will slow, don't think inflation's under control, think that the impact of these rate increases are going to be a lot of economic pain in a recession, of course, we are going to see something very different happen. So I want to provide some context, and this is the context with which we will look at how growth and income shares, growth and value shares, I really want to look at both sides of it, how they performed, and then what we can expect going forward, depending upon different scenarios, because of course nobody knows. And one of the reasons why we've had, just incidentally, the reason I went back a year ago, one of the reasons we've had some fairly, I don't know, significant's the right word, but we've had some fairly large losses in markets in the last couple of days. One of the reasons is because on Friday, Jerome Powell is giving his speech again. And so people obviously are very anxious. So Friday in the US, so Saturday, so we'll probably wake up to it Saturday morning. People are anxious and curious to see what he's going to say. Because of course, him coming out and giving a very different scenario than the one I've outlined here, that maybe inflation hasn't peaked, maybe interest rates are not going to slow, maybe there isn't a chance for them to be cut next year. Obviously, that's going to have big influences on markets. All right, so let's look at two different scenarios. So we've got scenario one, and obviously, listen, these are kind of extreme scenarios, and there's a lot of gray in between, right? But anyway, we can't do 500 scenarios. So scenario number one, the market is correct. So central bankers are going to be able to pull this off, right? They are going to be able to raise interest rates to a level that will lower inflation and bring inflation under control, but not too much to sink the economy. Pretty difficult, right? So to bring inflation under control and not sink the economy. And of course, we'll reference this a lot going back. The last time central bankers tried to do this, it didn't really go very well, right? And that's where we need to think about that period during the 70s. So during the 70s and into the early 80s, basically they let their foot off the gas too soon, kind of over and over again, right? So like inflation would go down. If you go back and look at inflation during the 70s and into the early 80s, inflation spiked, they brought it down, they stopped, then went back up again. So they never really raised interest rates fast enough, hard enough, far enough in order to destroy inflation. Now, very different economy, very different circumstances, but really it didn't come under control until the early 80s, where led by Volcker in the US, who was Jerome Powell's predecessor, well, not predecessor, but had the same job as Jerome Powell, many Fed chairs prior, raised interest rates so much, basically said that, okay, we need to quote unquote whip inflation now, those little pins they all wore around, that we need to raise interest rates so much that this doesn't keep happening, that we can't let this get out of control again, which means we're going to raise them until we crush inflation. Now, what he also did, is crush the economy. Right? And that's the way, if inflation gets ingrained in an economy, that's of course the way that you crush inflation, is you have to crush the economy, right? So that's just kind of the parallel period. So very different circumstances though, but that's just sort of what, of course, all these central bankers who are very knowledgeable about what happened in history, that's sort of the playbook, right? Don't go too fast. All right, so we've got a question, which I think is actually good, or something in the chat. All right, so Tyrone says, I can't understand how they could not see what was coming. Consumer spending, way over earnings, debt to earnings ratio above 100%, banks lending indiscriminately. Where is the surprise? It's just one example in Australia. If housing price drop and building slows, only get worse as consumers tighten their spending belts and habits. Okay, so I think that's a really good statement, and actually a really good statement to where we're going. One of the things that I think anybody, central bankers or not, we all have recency bias, right? We all look at what's happened in the near past and then kind of project it into the future. So that's why I think we need to go back and look at the environment we were in, kind of GFC and post-GFC, and frankly, it was even before. So if you think about what happened during the GFC, right? So obviously there were a lot of issues. You saw massive sort of government and central bank intervention. And, from a central bank perspective, right, like it was a ton of money pushed into the market. So lowered interest rates significantly. Then there was quantitative easing, right? They're going out there and buying bonds, pushing more money into the economy, keeping interest rates really low. So you saw these massive interventions. And at the time, we need to remember that everybody was sitting there saying, like, this is going to cause a ton of inflation, right? Like pushing all of this stimulus into the economy is going to cause a ton of inflation. So we have to be very prepared for it, but it never came. We'll talk about the reasons it never came, or potentially some of the reasons it never came. Then, of course, when COVID happened, all the central bankers and governments went through the same playbooks. Okay, we'll have like massive fiscal stimulus. So in Australia, like we'll go in with, job seeker, job keeper, do that. US, they just sent direct checks to people. You had interest rates lowered to zero. You had all this quantitative easing, even more aggressive than it was before. So you had all this stuff happening, and all the central bankers sat there and said, okay, there's going to be no increase in inflation because there wasn't before, right? We've done this before, and we've been doing this over and over again since the GFC. Every time there's a little problem, what happened? Interest rates were lowered, more money was pushed into the economy, and there never was inflation. So I think to give them some credit for hardly missing this, their argument would be, well, okay, we kept doing this and there was no inflation. So the question, of course, is why, which is why we need to sort of examine what's happening. Then we can talk about what shares will perform well. So one of the reasons why is there were all these deflationary forces. And remember, we haven't really seen a lot of inflation since the early 80s. And these deflationary forces have been accelerating. Right? So one of them is globalization. And globalization is very simple, right? At the end of the day, and, as terrible as this may be, it's still actually true. If you have a factory in Australia and you're paying Australian workers and you're dealing with all the environmental requirements, everything else you have to do to build a factory, well, it's going to cost you a lot more to produce something than it is if you have that factory in China. And that's what we've seen, right? We've seen massive offshoring of all sorts of things. So started with manufacturing, then started going into services. So you've seen all this offshoring, right? And all of that means that you can do things for cheaper. Of course, that's very deflationary, right? So that's the way that businesses, and we'll talk about sort of what businesses did with this, but that's very deflationary, right? The ability to go out there and produce goods and services for cheaper is really deflationary, all right? So you have that. You had technology-driven efficiency, right? So all of a sudden, your factory doesn't have, like Henry Ford's day, with thousands and thousands of people. Now you've got a bunch of robots and a couple people controlling the robots. All right, so technology there, technology in other businesses, right? So that's once again been able to keep costs down. So that's also deflationary. Other things we've had, of course, is we have had sort of changes, if we go back to the 70s, right? Like changes in the balance between corporations and workers, the sort of balance of power, right? So we went from a heavily unionized environment to a greatly reduced unionized environment. That took away bargaining power, right? So for all these things that we hear about, oh, the gig economy, it's so great. Well, the gig economy basically means that we're able to do a lot of stuff a lot cheaper because people are just sort of ducking in and out of the economy whenever they want and doing these jobs, and they're doing it for a lot cheaper than it will cost hire somebody full time. So you had all of these different deflationary forces, right? And what that allowed to happen is it allowed a couple things. Number one, we had very low interest rates, and sort of historically low interest rates, but without high inflation. And traditionally, that's been the problem. If you lower interest rates too much, you get a bunch of inflation. But we were able to do that. We were able to have low inflation. We were able to have low interest rates, which is good for businesses. And so what businesses did out of this, we also had a very benign tax environment as well. So, right, there were the Trump tax cuts, the Trump corporate tax cuts. We've had a lot of sort of personal tax cuts in a lot of different countries as well. So what basically happened is companies sat there and said, okay, well, this is great. And they had historically high profit margins. So if you go back and look at profit margins, you know, they are well above what they have been traditionally. So that's very important for a company because it means for the sales that they make, the money that comes into a company, they get to keep more. So that's really, really good for a company. So even if I'm not growing earnings fast, even if the overall economy isn't growing that fast, even if the overall economy is not growing that fast, I can still accelerate growing my earnings, right? So my sales may not be going up that much, but my earnings are going up more because I'm adding more and more margin. The other thing that we've seen globally is that if you think about an economy, right, as represented by the GDP, right? Well, there are different people who get different shares of that. And the corporations have been taking larger and larger shares over time of GDP as corporate profits, right? And so that's one place GDP can go. The other place it can go to you, right? So it could also be wages. Like workers could get higher and higher percentages of GDP, or frankly, the government can as well. But we've seen it go to corporations. So what have been the winners? The winners since the GFC have been growth shares. We'll talk about why. So it's been growth shares, it's been the US market, and those are related. And we've seen some cyclical shares that have done pretty well, but let's concentrate on the first two. So why do growth shares perform really well in this environment? We'll talk about it a little bit later, but low interest rates are good for growth shares. And they're good because the way that we value a company, of course, is we look at what the company's going to earn in the future. So we project out those cash flows. We discount them back to the present. And interest rates, of course, are a component into that discount rate. So the lower the interest rates, the higher that discount rate is. The lower the interest rates, the lower that discount rate is. Lower the discount rate, the less you're discounting things in the future, the more they're worth, right? Versus a value share, which is paying, which a lot of their value is very close in time. Or a growth share, they can be growing really fast for 20 years. Why is the US market performed really well? Well, a lot of the companies in the US, if we think about the US, and we'll compare it to Australia in a second, but like if we think about the US market, a lot of technology companies, and technology companies, of course, tend to be growth companies. Technology companies are companies that have benefited from a lot of this, frankly, globalization and offshoring and everything else. Like you think about Apple, right? Like Apple, even though they are a hardware manufacturer, right? They are building phones and everything else. They don't build any of them themselves, right? Apple designs software and Apple does design, of course, on the hardware, and then they just offshore building the phone, right? It'll cost a lot more to build that phone in California than it does to build it in China. So that's just an example, of course, taking advantage of that globalization. So the US market did much better than other markets. Like if you go back and look at the GFC, like US market, the returns are out of control compared to other markets, like the Australian market. We look at the makeup of the Australian market, it's very different, right? So we think about the kind of companies we have in Australia. Well, banking, and resources are a big component of it. All right, so that's scenario one. Then there's scenario two. Scenario two is basically that what the market has decided is going to happen, or hopes is going to happen, is not going to work. So inflation proves stubborn, right? So even there's been all this sort of, not that anyone knows, but everyone has decided that inflation has peaked. And let's say it has peaked, but if it's peaked at 9% in the US, it's a long way down to 2%, right? Which is what the Federal Reserve and central banks around the world are targeting, right? Inflation in the 2% range. So it proves stubborn, whether it either hasn't peaked or just refuses to go down much. That's a problem. What do we need? So higher interest rates will keep happening. So instead of this sort of rosy scenario where these sort of large cuts that have occurred, all of a sudden we don't see any slowdown. So Australia continues to raise by 0.5% or 50 basis points. The US continues to raise by 75 basis points or 0.75%. And it happens longer than people think it's going to happen, right? And that's why I think there's a lot of anxiety, obviously, around this Jerome Powell speech this week, because what is he going to signal? Last year, he told everybody, oh, okay, well, inflation's temporary. I'm not that worried. It will come down. And what happened? We had this huge spurt in the market. Even as things were starting to fall apart in the fourth quarter, remember that the S&P 500 and the ASX hit a high in early January, right? So we had this huge sort of rebound as people became more comfortable that these sort of early shoots of inflation were not actually going to take hold, that it was temporary. All right, so the other thing, of course, with higher interest rates is, do we get into this Volcker scenario, right? Where the scenario where interest rates are raised so much that it not only slows down economies, but pushes economies into deep recessions, and that is what's needed to get inflation under control. And just remember, once again, like that comment we had, of course, about like, how did central banks not see this coming? Remember, they're always going to go with playbooks or stuff that happened in the past. They all know what Volcker did. They all know the issue in the 70s, where we had this decade from the early 70s to the early 80s. We had this decade of really high inflation. They don't want that to happen again. So just remember that they're probably sitting there dusting off that playbook. And if inflation is stubborn, my prediction would be, if it doesn't come down, that they would keep pushing up interest rates, even if it drove economies into a recession. All right, so what does this mean? It basically means that this environment that we had since the GFC was actually a historical anomaly, right? Because it was. Now, maybe if it continues on forever, if we go right back to that, that's kind of what the market is thinking right now. Oh, we're going to go back and we're going to have interest rates cuts next year, right? So the market's thinking the same thing. Like, okay, we can get back into this environment where we can just have really low interest rates and not have inflation. We just have to get back there. Well, if that environment was a historic anomaly, we need to go back and look at what's happened, right? So if we look at mean reversion, right, and like nobody's sitting there suggesting that interest rates are going to go up to what they were in the early 80s, right, where we're talking double digits, right? And you hear all these stories. When I bought my house, I paid a 17% mortgage, right? I don't think anyone's saying that, but if we go back historically over the long term, interest rates are in the 4 to 5% range, like kind of on average. Right. So, and that there's many people that see that as something that is like impossible to have happen, but that's just moving back. That's just mean reversion. It's just moving back to the average. So what is this going to do? If we have higher interest rates, number one, back to scenario one. Number one, there's obviously going to be a lot of problems that are created in the economy, especially in Australia. If this is sort of longer term with variable rate mortgages. So you're going to see a lot of spending drop. From an investment standpoint, you're going to see lower valuation levels and probably lower profit margins. So who would be the winners in this scenario? Well, probably nobody immediately, right? Like, this would certainly take any sort of steam that we have out of the current rally, could obviously go retest and go through those lows we saw a couple months ago. but probably nobody's going to be a winner. But from a relative perspective, value shares could be a winner, right, in this different environment going forward. Dividend paying shares, so income, non-US markets. So US markets are trading at higher valuation levels still than other markets. So this would be a case where the US will probably underperform. And then, yeah, we could see non-cyclical shares, right? So if the economy is doing poorly, right, if interest rates push economies into a recession, all of a sudden we're looking at those non-cyclical shares that don't follow the economic cycle, because the cycle would not be in a good place. So we'll see what happens. I have my own thoughts. But let's talk a little bit about characteristics around income investing and in growth investing, because that's important as well. So it's important to understand the environment and understand how different things perform in different environments. So let's just talk about a couple characteristics. So income investing. So income can be very effective depending upon, in investing for income can be very effective depending upon where you are in your life stage. So if you want to lower the volatility of your portfolios and or support withdrawals from your portfolios to pay for goals. So what does this sound like? It's retirement, right? Like as we move into retirement, but it could be other goals as well, right? As we move into retirement, we want to lower that volatility in our portfolio and we want to support withdrawals, and income can be good. Now, why is that? Well, there's two different reasons. So number one, and this kind of is with the third bullet point, so we'll repeat it. But number one, income paying companies generally bounce around less in price. And they bounce around less in price because, number one, it's a reason to hold on. So you do, of course, have a reason to keep holding the share, that you are paying, that it is paying a dividend. But also when you think about the type of company this is, right? So in order to pay dividends, you need to do, quaint little things like make money and have cash flow that support those dividend payments. You likely have to be in good financial shape in order to pay out a dividend. You probably have less prospects to invest in, which we'll get to in a second. So instead, you're just returning money to shareholders. So you're going to have lower growth. That's going to put you in that value space. Once again, you're going to have lower volatility. So all these different things around income paying shares lower the volatility, and they support withdrawals from our portfolio very simply because it's cash, right? So if we're in a period where share prices are falling and we have to take money out of our portfolio, we have to do it to pay for our life, and we have to do it because frankly the government tells us to do it and take money out of superannuation. So why does income matter then? Because of course a portion of the money you're taking out can be cash that you built up from those dividends, and not selling shares when the market is not doing well. The other thing is, if we think about different environments we're in, right? There are higher return environments, which we've certainly been in since the GFC, and there are lower return environments. So in lower return environments, and we think about the three different ways we get returns as companies, or we get returns on shares. Like number one, of course, you can have earnings growth, right? So if the company is growing, that's going to be a source of returns as long as valuation levels stay at the same place or go up, right? What somebody's willing to pay for those earnings. If those earnings are growing, it's a good thing, right? The other thing we can have valuation expansion, right? So whether your earnings are growing or not, instead of paying 10 times earnings, I'm going to pay 20 times earnings. So that's the place we get returns, right? Then the other portion is dividends. Now, in an environment where we're not seeing fast earnings growth, which could be the economy's not doing well, and we don't see valuation expansion, right? And we see valuation expansion generally when interest rates go down. So in those environments, dividends will make up a bigger percentage of your total returns, because that's the other source, of course, people that pay you. So that's why they can work very well. And then, yes, we touched on this point as well, that there are these other characteristics. So a lot of the characteristics around, okay, there is companies that generally are bigger, companies that make money, companies that are in good financial shape, all these characteristics, slower growing companies, all these characteristics are sort of lower business risk, which equal lower volatility. So they can perform worse in environments where we see growth shares doing really well, but better in environments where we see things slowing down. All right, I know we've got a couple questions, so we'll just go through growth as well. Okay, so when is growth investing really effective? So it can be really effective in periods with rising valuations, which is certainly what we saw from the GFC through COVID, right? So rising valuations, because of course, as valuations go up, if a company is growing quickly, each year as it makes more money, of course, and those valuations go up, it's like we've got a turbocharge on the returns we're getting. So that's when growth investing can be very effective. It can be more effective in sinking interest rates and rising interest rates. So that's that same thing we were talking about with those future cash flows and the discount rate. And the fact that a lower discount rate generally makes valuations go up, right? And that's going to matter more if you're growing, as we talked about in the first one. We also need to remember that growth investing generally has a wider range of business outcomes. So what that basically means is that a growth investment is, of course, forecasting very fast growth into the future. And what that means is like a lot of stuff can go wrong and impact that, right? So it is hard to grow a company really fast. So of course, you can have a wide range of business outcomes. And if you're a company slowly plodding along, selling the same stuff to the same people, or if you're a growth company coming out there in some new market where we don't really know what's going to happen with it, that's trying to fend off lots of competitors and figure out how this market grows, you just have a wider possibility of business outcomes, right? So it can be really, really good, and it can be not so good. With a lot of value companies, you have a narrower range. All right, so let's see. Got some questions. All right, so we got a question. Would cash in the bank be better in scenario 2? So just as a reminder, of course, scenario 2 is the economy is not doing well. The inflation stays stubbornly high. The economy is not doing that well. Would cash in the bank be better? Well, cash in the bank could be better if the market falls significantly and then you want to get into it. But remember, over a long period of high inflation, cash in the bank is kind of the worst thing you can have, right? Like even if returns on shares are not great, that's better than losing real money, keeping it in the bank. So it obviously depends. So Rory says, how does a bucket strategy impact on the strategy of focusing on income investing in retirement? Yeah, so if we think about a bucket strategy, so remember, a bucket strategy is an approach to deal with volatility as you start pulling money out of your account. So basically, what we need to remember with a bucket strategy is, and the idea, of course, is that you have lower volatility buckets, so like a cash bucket. And a cash bucket, of course, has no volatility. And when the markets are not doing well, right, as investors, we don't want to sell when the market's not doing well. So if the market's not doing well, we use that cash bucket to pull out funds to support ourselves in retirement. Now, the concern that you'll have eventually is that that bucket needs to be refilled. So one of the decisions we have to make with the bucket strategy, depending upon how conservative we are and what our financial situation is and our needs, is how many years worth of expenses to put in that bucket, right? So we could put 1 year of expenses in the bucket saying, I think the market will recover in a year. I'm comfortable with that. And then when that bucket's out, when I take 1 year worth of living expenses out of that bucket, then I'll sell things then. Some people could say, I want multiple years in a bucket because I want to be really safe and I don't want to have to sell things. So the question is, and what you get out of income is the income can actually be a scenario that refills that bucket without you having to sell. Right, so you're clearly not at a point where you can only survive on income, which is difficult because you need a lot of money. But you could be in a place where, okay, if you have a couple of years in that bucket and maybe you can generate 6 months worth of living expenses out of income in a year, well, at least you can get another year into that bucket if you've got 2 years and you're just taking it out. So that's something that I would say about kind of the bucket strategy related to this. So the last thing I kind of want to talk about, and obviously ask any other questions, But the last thing I want to talk about is, okay, what are some of the things that we need to look at if we're investors and we're trying to evaluate a growth investment versus, let's say, an income investment? What are some of the things that we need to look at? All right, so let's think about growth. So in a growth situation, there are two primary things that we need to worry about. Number one, we need to worry about the market in terms of the total addressable market by the company. And remember, in many cases, we may not know because it's going to be an emerging market. And let's take, just because everyone's heard of this, we can take electric vehicle sales, for example, right? There's all these projections on the market for electric vehicle sales, but nobody really knows, right, at the end of the day. So we have all these different estimates that, we think that prices will keep coming down. We think as prices keep coming down, sales will go up. What percentage of vehicles are going to be electric vehicles? Now, some people would sit there and say in 50 years, it's going to be all of them. Some would say no, but whatever. We need to have an estimate of the market, right? So the first thing we're doing when we're analyzing a business that just sells electric vehicles is we need to analyze the market. How big is it going to be? And we call that total addressable market. So that's basically just saying, how big is this opportunity? So that's really important. So understanding the industry that your company's operating in and where you think it's going to go. The next thing that's really important is, of course, understanding the competitive dynamics between different companies. Because, of course, nobody's just going to go out there and not get competitors if there's this huge market. And yeah, this is the whole capitalism point, competition. So then it's really important to understand those companies, understand their competitive advantages and the competitive relationship between different companies and what will happen to that competition and what that competition will do to companies, right? And a good example here is buy now, pay later, right? If we kind of think about, everyone was very, very focused with buy now, pay later. They were very focused on the total addressable market, right? So you heard all this stuff like millennials will never get credit cards and they don't like credit cards. So you basically got this generation as a total addressable market. So everyone was very excited about that. All these companies rushed in there. But what people didn't consider was what was going to be the impact of all this competition. And what was the impact? Well, okay, now all of a sudden you've got all these companies with no real moats, no sustainable competitive advantages, battling it out for this market share. So you saw really high spending on marketing. You saw the prices, their margin come down, number one, because of really high marketing spending, but you also saw the prices they were charging come down. Remember, like Afterpay used to charge this enormous amount to a retailer, right? Because Afterpay would come in there and their pitch would be, hey, yeah, you're going to pay us 7%, but your sales are going to go up 20% if you take on our service. Well, all of a sudden it wasn't just Afterpay showing up, it's Zip and all the rest of them, right? They have all these different buy now, pay laters, and the banks jumped into it and PayPal started doing it. So all of a sudden there's all this competition. So the retailers can sit there and say, well, Afterpay, I'm not paying you 7% because I'll just use these 20 other services. I bet you my sales will be fine. So that's just an example of saying, okay, we saw this big addressable market, but we didn't think about those competitive forces that were actually involved. So that's really what you need to focus on in growth, right? You need to make sure that that growth that's projected is going to happen. And those are the things, of course, we need to look at. How much can we grow? And then how much can we keep? Okay, the other thing, of course, is if we start looking at income paying shares. So what are we very concerned about with income paying shares? Well, if we're investing specifically for income, we are really concerned with, of course, their ability to continue to generate that income. And some of this is similar, right? It's understanding that industry. You don't necessarily have to understand some future industry. What you might be understanding is an industry that's in decline, right? So that's what you might have to figure out. Like, okay, how much is this industry going to decline? And what is their ability? Who's going to be the winner? Right? Are we going to get to a spot where as the industry declines, we have less people competing in it? Or is there some company that's so superior, right? Like when things are growing really fast, everyone can kind of get a little bit of that pie. But when things are shrinking or staying the same, okay, is there some competitor that is so efficient or has so much scale that they can go in there and expand their market share, right? So that's what we're more focused on. We're focused on then companies that have, once again, have competitive advantages, but companies that also are in good financial shape, companies that are more efficient than other companies, all the boring things that you don't need to worry about if you are in this really fast-paced growing industry. Like, okay, what company can actually do things really, really efficiently? So Hugh asked, could you please comment on defensive stocks in scenario 1 versus 1 and 2? Yeah, so what I'd say is if scenario 1 happens, so basically, this is central bankers get this completely right. We go back to an environment we were sort of used to from the GFC on. So we get back there, defensive stocks basically did not perform very well. So at the end of the day, it was all these growth shares. It was the NASDAQ. It was all these technology companies that did really, really well. And defensive shares did not do as well. And you're probably likely to see something pretty similar, I think. So once again, in an environment where all of a sudden next year we start to cut interest rates, and we get interest rates down to where they were before, I think that's what you're going to see. So in scenario 2, I would expect to see defensive shares to do a lot better. So basically, if you want to see what scenario 2 looks like, just go back and look at kind of what happened for the first 6 months of this year. So what we saw there is we saw this massive rotation from growth back into value. And part of it was sort of episodic, right? Part of it was, of course, what are value shares? Well, value shares are a lot of resource shares, and we saw commodity prices going up, which we often see in inflation. In many ways, at least during that environment, banks would be considered pretty defensive. So that's what you would see. So you would see them outperform. Now, remember, outperformance, you can outperform something and have everything go down, right? Which is what we saw, right? In that 6 months, everything went down, but we saw value outperform growth. Okay, so we've got a question from Richard. Would franked dividends would better serve some people rather than paying capital gains tax? Okay, yeah. So listen, let's talk about this. In lower return environments, once again, stuff like taxes, minimizing your taxes, and then minimizing the fees you pay matter more, right? So if the market's going up 18% a year, okay, who really cares if we pay fees? It still does matter, but people think about it less. We're in a lower return environment. We're making 18% a year, and you're paying 1% a year in fees. You can live with that. If we're growing 7% a year or 6% a year, and you're paying 1% in fees, yeah, it's a lot more difficult to live with. Same thing with taxes. So if we talk about taxes, capital gains taxes, so of course we are assuming everyone's tax situation is different, but capital gains taxes is basically what you're going to get out of growth shares at the end of the day, right? How do you get many growth shares, of course, do not pay dividends or pay very low dividends. And the reason for that is, right, they're growing so fast, they want to take that money and reinvest it in the business. So if I'm an investor then and I want to get money out of my account, I, of course, have to generate capital gains taxes. Or as an income investor, if I want to take money out of an account, well, I can get it out through income that I earn as well. And we, of course, have a massive tax advantage here in Australia to get dividends, especially franked dividends, right? Because what that's going to do is just boost our return more. Yes, we will still have to pay taxes, of course, on those dividends, but we're going to get that boost from franking credits. And right, if you go back, if you go back to 2012 and look at, or it was 2011 to 2021, I think is the last time we looked at that research, you were getting an extra 2% a year as an Aussie investor, depending upon your tax situation, in franking credit. So it's extra return that you're getting. So of course it makes up for those taxes you have to pay on those dividends. So yes. All right. We seem to be out of questions, which is exciting. Means I can go get a Coke Zero before my meeting with Emily. So that's Emily up in the corner over there. She gets really embarrassed when I talk about it. But yes, I've been meeting with her, so I'm going to go get a drink. But anyway, thank you guys for joining. If you'd like to come to our conference or want a discounted ticket, email me at mark.lamonica1@morningstar.com. Yeah, if you have any questions, just send them through as well. So thank you guys for joining.
Any advice in this video is general advice or regulated financial advice under New Zealand law prepared by Morningstar Australasia Proprietary Limited and or Morningstar Research Limited without reference to your financial objectives, situation or needs. You should consider the advice in light of these matters and any relevant product disclosure statement before making any decision to invest. To obtain advice for your own situation, contact a financial advisor.